Well, friends, good morning. So, the topic of the day is probable maximum loss. Probable maximum loss, or in short, PML. So, the probable maximum loss is the maximum loss that an insurer would be expected to incur on a policy. A probable maximum loss is most often associated with insurance policies on property such as fire insurance or flood insurance. So the probable maximum loss represents the worst case scenario for an insurer, provided that there is no failure of existing safeguards such as fire sprinklers or flood barriers. So this is usually lower than the maximum foreseeable loss, the potential damage if such safeguards fail. So maximum probable loss refers to the insurer's estimation of potential liability in the worst event. Possible means something that can happen. Probable means something capable of being proved or which may reasonably be expected to happen. Wherein reasonable is meant in the sense of having sound judgment of or sensible or as is judged appropriate or suitable to the circumstances or purpose. So PML concept is one of the main tool used in underwriting, especially in property insurance underwriting. So the underwriting and use of PML concept enables an insurer to maximize his retention capacity and the returns, control the exposure for the own account, and use the right combination of reinsurance techniques to manage the risk. So underwritten on probable maximum loss basis means fire reinsurance in India is underwritten on PML basis, which means retention limits are decided based on the PML of a risk and in simple risk on sum insured basis. So insurance companies use a wide variety of data sets including probable maximum loss when determining the risk associated with underwriting a new insurance policy, a process that also helps set the premium. Insurers review past loss experience for similar perils, demographic and geographic risk profiles, and industry-wide information to set the premium. So commercial insurance underwriters use probable maximum loss calculations to estimate the highest maximum claim that a business most likely will file versus what it could file for damage resulting from a catastrophic event. So underwriters use complex statistical formula and frequency distribution charts to estimate PML and use this information as a starting point in negotiating favorable commercial insurance rates. Now the question is how to calculate the PML. So there are several steps in calculating PML. Determine the dollar value or rupees value of the property to arrive at the potential financial loss from a catastrophic event. If the entire property was destroyed, so determine the risk factors that are likely to cause an event that would lead to damage or loss of the property. This can include the location of the property. For example, properties on the ocean shore are more prone to flooding. It can also include building materials. Building made to wood are more susceptible to fire. Take into consideration risk mitigating factors that can prevent damage or loss, such as proximity to a fire station, alarms, and sprinklers. A risk analysis will need to be performed to determine the scale at which the risk mitigating factor will reduce the probability of an event that would lead to damage or loss of the property. The last step involves multiplying the value of the property by the expected loss percentage, which is the difference between the expected loss and the risk mitigating factors. So for example, if a home is on shore and its value is $3 lakh and the house has been raised on stilts to avoid flooding as a risk mitigating factor, which reduces the expected loss by 30%, then calculating the probable maximum loss would be $3 lakh upon 100% minus 30% is equal to $2,10,000. So the example above is simplified version and the more risk mitigating factor that a property has. The further the probable maximum loss will be reduced. Most properties are at risk of damage by a variety of means, and so ensuring protection against all variables will not only benefit an insurance company in the amount they will have to cover in case of a catastrophic event, but it will reduce the premiums a policyholder will have to pay. Now, what is maximum foreseeable loss? The maximum foreseeable loss is an insurance term most frequently used in the insurance of businesses and business property. So maximum foreseeable loss is a worst case situation in which the claim for damages and losses are significant. The maximum foreseeable loss is a reference to the most substantial finance hit a policyholder could potentially experience when an insured property has been harmed or destroyed by an adverse event such as a fire. The maximum foreseeable loss assumes a malfunction and non-response of the usual safeguards like sprinklers and professional firefighters that would typically limit such a loss. So key features of maximum foreseeable losses are: maximum foreseeable loss is an insurance term usually applied to a protection of a business or business property. MFL is a reference to a worst case scenario, the largest hit a policyholder could experience if the insured property has been harmed or destroyed. And typically the damage comes from an adverse event including fires, tornadoes, hurricanes, or other kinds of natural disasters. So a claim for a maximum foreseeable loss is extensive, as it will include not just physical loss such as property, the housing, the businesses and the products, supplies and equipment owned by the company, but also the impact the adverse event had on the day-to-day running of the operations. But the policy acknowledges the potential loss of businesses called business interruption, which is likely unavoidable while repairs to the property are ongoing, depending on the size of the property, and the extent of the business repairs could take weeks or months. So the business interruption might be complete, 100% or partial, say 50%. So depending on whether it is possible to resume business at another physical location or in some cases digitally. So the maximum foreseeable losses refers to the worst case scenario that a company might potentially face should an adverse event occur. Now, most unfavorable circumstances are there, like peak season, maximum volume quantities and continuity of combustible storage, maximum possible impact on the businesses, adverse but usual weather conditions, strong winds in autumn, dry weather in summer, freezing in winter. So PML calculation methodology includes property damage and business interruption estimates should be based only on current replacement value. PML should not exceed 100%. Do not include extra expenses such as debris removal, decontamination cost, demolition, increased cost of construction, interdependencies. Underwriters are exposed to adjust PML calculations based on accounts first loss sublimit if opted for. And the PML estimations for petrochemical plants slightly differs because the scenario may be like accidental leakage of pressurized HC to form unconfined vapor cloud which explodes after coming into contact with a nearby ignition source. So overestimation of PML versus underutilization of capacity may harm the business firms. As the insurer is interested in knowing PML for the net retained account, so the data needs to be segregated into small, medium, and large risk information, and underwriting breakup needs to be applied to arrive at that portion of exposure applicable to net retained account. So the fire tariff classifies India into 4 earthquake zones with respect to frequency and severity. It is therefore necessary to refine the grading classification given in the tariff as an indicator to a micro level. Therefore, it is necessary to attach a severity frequency coefficient to each of these geo units. This coefficient factor is nothing but a PML factor derived empirically. So the PML factor is applied on the known aggregate exposure sum insured to arrive at a potential cat event loss. This computation is repeated over different geographical zones collectively, once for each group of unit zones which are exposed to a single unit or single event. The highest of such values represents the amount of catastrophe protection the insurer needs to buy. So the protection against catastrophic loss is provided by excess of loss reinsurance, which limits the maximum loss that an insurer is exposed to under any one event. So an excess of loss reinsurance comes into operations when the total net loss suffered by the insurer due to one event exceeds the figure agreed in the treaty. Such excess of the amount or a proportion of it being paid by the reinsurer subject to a maximum limit. So the net loss means the loss computed after taking into account recoveries from facultative and treaty reinsurers. So the total net loss exceeds the maximum limit provided in the treaty. The excess amount remains for the account of the ceding reinsurers. It may, however, be absorbed under a second excess of loss treaty. For example, an insurer can avail protection under excess of loss cover by arranging it in different layers, say layer 1, layer 2, and so on, wherein the preceding layers will be the underlying for the succeeding layers. So PML and CAT excess of loss treaty is important to understand, because the CAT excess of loss cover protect the insurer's net retained account from losses of catastrophic nature. For example, losses caused by weather perils such as storm, tempest, flood, and inundation, natural perils such as earthquake and resultant tsunami, landslide, bushfire, etc., and political risks such as riot, strike riots, civil commotions, or event conflagration. The underwriters keep risk excess of loss, individual single large loss, and CAT covers event losses separate from each others by two risk warranty clause. So for an event loss, a minimum of two separate risks should have been affected by the same event. So depending on the degree of damages related to the assessment of the property, a loss figure for property damage can be determined. The loss estimations are based on a variety of different information, including geo-information, empirical losses data, site visits by engineers, and publicity available and private data. Yet to simplify the understanding, loss estimation can in general terms be broken down to multiplying the sum to be insured by a percentage damage factor. So the percentage damage factor, however, is dependent on the individual assessing the property and can be difficult to determine precisely. So this is the probable maximum loss. Thank you very much.